Broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Thank you all for joining us today for CIO's Corner. This is a newly added webinar that we will be hosting quarterly to discuss what is going on in the investment environment. For those of you who are not familiar with Stonehearth, my name is Amanda Murray, and I am the Client Service Associate for the firm. I have been with Stonehearth now for almost 3 years, and my role focuses on client service, marketing, and compliance. I would like to review a few line items before we begin here. You should have a questions box on your taskbar in which you can submit your questions at any time during today's webinar. I will be personally monitoring your questions as we go along, and we will answer as many questions as we can here at the end. You can also find all of our webinars on our website at stonehearthcapital.com if you click resources and webinars. All of our webinars are recorded, so you'll find all of our past webinars listed there for your viewing at your convenience. Also, you will find the calendar of our upcoming webinars. Our next one will be hosted on Tuesday, November 28th at 2 p.m. Our Senior Financial Advisor, David Giuliano, will be hosting our Executive Corporate Benefit Planning. So please go ahead and register for that if you find that that information would be beneficial to you. I'd like to now introduce our speaker for today, Stonehearth's Chief Investment Officer, Chris Gauthier. Chris has been with Stonehearth for 5 years and has been in the investment management industry for 20 years. He's responsible for setting the Stonehearth's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions, and he also acts as the chairman of our investment committee. Chris, thank you so much for joining us today.
Thank you for that nice introduction, Amanda. I want to thank you also for saving me there. I started a little bit early there, so Amanda kind of jumped right in and saved me, so I apologize. So what we're going to talk about today is we're going to start a quarterly webinar series called CIO Corner, where every quarter I'm going to give an update of kind of what happened during the quarter, what's going on in the investment environment, how our portfolios are positioned. And for those of you who are familiar, we have an internal risk model that we use here to kind of monitor what's going on in the markets. And we'll kind of go over what's that telling us in terms of what's going on, what could potentially happen, and how we're using that information to position portfolios for our clients. So with that, I'm going to go over today and talk about what we're going to cover. So right here, what we're going to cover is, again, asset class performance in Q3 2017, what happened over the past quarter, the current investment environment, and how we're positioned to take advantage of this. So let's look at what happened during the quarter. Again, Q3 2017, as it has been all year pretty much, was a Goldilocks scenario for risk assets. Again, looking at the chart, you can see there's not a lot of negatives. You really have to search out to see negative returns here. And the only one that's really negative on this chart is the dollar. Not everything is on fire, so not everything is going up 4, 5, 6, 7%, but everything is on. And what this chart's telling you, as we look at the color coded here, is when we look at the colors, yellow, those are what we consider alternative asset classes or commodities. So you'll see gold right in the middle, up 3% during the quarter. Oil was up over 10% during the quarter. That after being down over 8% the quarter before. So, some of these asset classes are very volatile. Green, if you see anything in green, that's all international, including emerging markets and frontiers. Anything in that light blue color, that's going to be anything domestic. So U.S. equities, think small caps, S&P 500, some mid caps. Anything red, those are asset allocation funds. So those are funds that are traded in the market that have a diversified multi-asset class portfolio. And those are kind of what our diversified asset classes follow. Anything in purple, fixed income, including international bonds, junk bonds, muni bonds, long-term treasuries. So as we're looking here, you can kind of see at the colors, stocks outperform bonds, international stocks outperformed U.S. equities. And September is the 11th straight month of gains in U.S. equity market. But the one thing we start to see change in the third quarter compared to other quarters is you start to see these international markets pull ahead of the U.S. So even during the quarter, Frontier outperforms one of the best performing asset classes out there at over 7.76%, just like emerging markets and international. That outperformance kind of pushed the one-year performance of the international markets above the US markets. And that is a big change. We've been seeing the S&P 500 lead these markets and the NASDAQ for the past 3 or 4 years here, and we're starting to see the international come up. And as you see in our portfolios, we like that, we're positioned for that, and we think that will continue given the valuation scenarios. So that was kind of what happened during Q3. But again, looking at history is fun, it's interesting, kind of know what happened, but what's more important is what's going to happen. So let's look at the current investment environment. So when we look at the current investment environment, the first thing we see is valuations are stretched. I mean, there's no doubt about it. Trying to find any assets that offer value out there is very tough. But there are pockets somewhere trading at somewhat reasonable value. So I don't think there's anything that home run, that fat pitch we look for that's so cheap you have to own it. But if you look far afield, if you look at the numbers and the metrics, you can find some reasonable asset at some decent valuation levels out there. You just have to know where to look, and we'll show you where to look coming up. Second, synchronized global growth. This has been one of the most synchronized global growth stories we've seen in a long time here, pretty much throughout history. We have a few charts to kind of show you how that translates into the markets. But again, trade is ramping up. Every country, again, may not be on fire, but every country is on, which is very unique in the global environment. Thirdly, I should say, central banks are still in control. I'm not going to go into whether it's a good thing or a bad thing. There's a lot of debate, a lot of people on both sides of the issue, whether central banks are artificially holding down rates and causing trouble in the markets, or they're doing right by the markets by holding rates down. I'm not going to argue either one. If anyone would like to discuss that, please give me a call. I'll kind of give you my opinion on what that leads to. But what we're really looking at is what's going on. And whether you agree with them or disagree with them, they're in control. They're running the show here. They're keeping rates very low in this current environment because they're not seeing inflation. So if they don't see inflation, then they have an impotence to keep these rates low for a long time. Doesn't mean they can't rise, and I think they will rise, but again, there's nothing really pushing them off the ledge to raise rates. And with that environment, there is little and no income to be had anywhere. Do not reach for yield in this environment. Trying to find income is tough, and we'll kind of show you how that plays out historically. Lastly here, volatility. I should say lack thereof. There's just no volatility to be had. Investors are very complacent. Sometimes that's a good thing. And they're complacent, they keep investing money, market keeps kind of trending upwards here. But throughout history, we do know that one of the indicators of a market that is maybe getting a little bit overextended is widespread investor complacency. So we are seeing that here and there, and we'll show the numbers to kind of show how that translates. But again, we look at multiple lenses here, so even one thing is flashing negative doesn't mean we're negative on the whole entire market. But again, volatility or lack thereof is a big problem in this market. So that's kind of the overall picture of the investment environment. And we're going to look in some details of each of these indicators right here. So let's look at some valuation. So what we're looking at here is a chart from State Street Global Advisors, their ETF chart pack they release every month, which is a great resource for us over here. And what we're looking at here is over time, the price to book. Price to book is a typical valuation measure. It's one of many. They're all saying the same exact thing, risk is expensive. So what we're looking at here, if we look at the S&P 500 index over here on the left, giving the valuation spread, if it's high, it's expensive, low is cheaper. So the 15-year low, 1.64. Look up here, looking for the 15-year high, is that triangle, 3.19. Historically, it's averaged over the length of its history at about 2.5. So kind of when you're looking at this, you can kind of think if it's below or near this kind of light blue, then it's cheap or, you know, fairly valued. Above that or near the top, then it's expensive. Look at the S&P for the current, which is this triangle, and it's on all these charts. You can see, boom, highest it's almost ever been, 3.19. The highest we've seen over the past 15 years is the current environment. That says expensive. We move over to the small caps in US space, still above the historical average, so we still think it's expensive, but not as expensive as large cap. So maybe a little bit more value there. Now we start moving down, we're looking at the international world now. This is the IFA, so think about developed, think about Japan, think about Europe. This is what this is investing in. Boom, it's right on its average. So again, we're starting to see some pockets here that are trading at decent valuation levels. You know, nothing trades at its average over 15 years. It kind of goes up, it goes below. It's called mean reversion. So the funny thing is everybody says mean reversion goes back to the average. No, what mean reversion means is that it goes up and down around the average. So again, we're thinking international offers some good value here. We move over to emerging markets, again, right on the historical average, maybe a little bit lower. So again, what we talked about in the beginning of this webinar is finding pockets of assets trading at decent valuation levels. And this is where we're finding it in emerging markets, international. Japan's trading under its average. If we go over here, Europe's a little bit expensive than historically. But again, when we compare this to what we're seeing in the US, we just don't think you should put all your eggs in one basket and invest in a highly overvalued market like the US. It definitely makes more sense to spread it out more to the international, where we're finding better values than what we're seeing in the US. So now we took a look at equities, let's take a look at fixed income. Now, I'm sure most people are familiar about how equities are overvalued or how to measure them, and they're not so sure about fixed income. It's kind of a strange world, not a lot of people. The news doesn't report on it because it's boring, it's just math, which I find strange that people find math boring since I love it and drives so much things out there. But again, society, math is not rewarded here. So what we're looking at the bond market is spreads. So in terms of pricing out bonds, and when you try to value bonds, it has to have a reference rate. That reference rate is the Fed funds US Treasury rates. So everything trades at a spread, because if you think about it, if I wanted to get income and I wanted to take no risk, I buy a US Treasury. They'll give me a little bit of income, that's it. If I want to take more risk, get some more income, I have to buy a different type of bond. When we go to look at that, like this corporate bond right here, right in the middle, we look, okay, there's a Treasury income that I get, but then I also have to have more income for the risk I'm taking by going into the corporate world. That difference is called the spread. So again, just like in our equity world, when we look at the price to book spread over history of time, this is the same exact thing. It's the same exact spread. So if you look at that corporate index, at the highest it's ever been over the past, I think this is 15 years too, 15 years, is 618. The lowest it's ever been is right here, right at 76. The current is 101. So again, one difference between this and the equity market is that this is reversed. The cheaper, the lower the spread, the more expensive. So the lower it is, the more expensive it is. The higher it is, the cheaper it is. So that's a little bit different from the equity market. So what's these saying? If you look at all these white dots right here on all these asset classes, they're expensive. Again, goes back that trying to find those pockets of a little bit of cheapness. And when we look, we see it. Floating rate, a little bit cheaper, a little bit better than what other asset classes are trading at. Emerging markets, definitely, but I don't think they offer as good as value as floating rate because they have duration risk, and we'll show you what that is in a few minutes. And the high yield market, which again, trading at some of the historical low in spreads. So again, what are you looking at here? You're looking at another very expensive market with expensive asset classes throughout, with a few pockets here and there of some assets that might provide some value. And again, what this overall valuation level is telling us in both the equity markets and the fixed income markets is that you're not being compensated for taking on risk in the face of rising rates in the valuation picture. So taking on more and more risk does not offer a good value at this point. So that's where we stand from valuation picture. Again, it's been, since I've been here at Stonehearth Capital Management in 2012, the valuation picture has never looked good. It really hasn't looked good since, the literally end of 2009. Valuation alone does not tip markets into a bear market. It will not sink a market, which is why we use multiple lenses. So again, we look at the valuation picture, which is a big part of our model, but we also want to look at the economy. And really, since I've been here, this has been one of the three legs that has really been on fire. So let's look at the global economy here. So what we're looking at here is a heat map. Again, green is good, red is bad, for those just kind of want to get the high level here at this. This is manufacturing growth. This is the PMI. So we use the US version of this in our model, and you can see the US is right here on the top line, right there. So it's at 53.1 as of the end of September. We use that in the model. People may not be familiar that every country kind of has their own purchasing managers index. It's a measure of manufacturing. Is the country manufacturing more or less? So the way to read this chart, other than green is good and red is bad, is that when this index is at 50 or above, then that economy is expanding. When it's below 50, then the economy is contracting. So again, looking around at the world, what do you want? You want a country expanding. That's growth. That's good for the world. Um, the interesting thing to note here is you look at September, everything is green. Again, we talked about this synchronized global growth. All countries are in expansion mode. Again, not all on fire, but all in expansion mode. This is not always the case. This only goes back to October 2015, but you can see that there's variables that you don't usually get everything working at once, that, maybe emerging markets are trailing here like they did in October, even though you had some UK good growth at 54, Canada was trailing at 48. You go back to this September and it's tough to find how we have a recession given the global growth and the widespread global growth we're seeing. Again, we don't need global growth of 6 or 7%. That'd be nice. I would love to see that to keep us out of a recession. We just need global growth. We just need some growth. So that's the PMI index. When I look at GDP, again, I'm sure we're all familiar with the US version of GDP, which just measures how much our country produces. They do the same numbers for the world. So what you're looking at here on this left chart is you're looking at real GDP, which is this shaded area here, inflation, because everything's measured before inflation in terms of GDP growth. And this black one diamond right here is a nominal GDP. So the takeaway here is better. It's up at 6%. That's great at nominal. Real GDP, which is when I quoted I want 6 or 7% real GDP growth, it's more at 3%. Again, not on fire, not extraordinary, but given where we are in the market cycle, good enough to kind of keep assets in this range here. So again, not looking for anything to tip over, looking for that tipping point. We just don't see it in the marketplace right now. When we come over here, we look at the global GDP growth, and it's also looking at global earnings. Again, sometimes in the US, we get too focused on the US and fail to see what's kind of going on in the world. Again, the way to read this chart, it's turning the right direction. It's heading up. Things are growing. We see growth in the market. We don't see anything kind of rolling over, turning over, or anything like that. We're seeing good growth. So again, very, very strong economic backdrop to this. Tough valuation picture. Before we get into our model, we're going to look at the third piece of what we talked about at the beginning of this, central banks. So again, central banks are in control. There is no doubt about it. Anybody looking at this chart, the first thing it screams out them is low, low, low. And it is causing distortions. Now, we can argue whether they're good distortions or bad distortions, but there are distortions in the marketplace by holding this that low. So we look at this chart over here on the left. This is the BOE, which is the Bank of England, BOJ, Bank of Japan, ECB, the European Central Bank, and the US Federal Reserve, which we're more familiar with. If you look back here in 07, and Japan's the outlier, because they had those problems in the 90s where they've been trying to generate inflation forever and just can't. But they were the first ones out of the gate with this lower for longer rates. But we look at the more normal Bank of England, Japan, ECB, we were all up around 5%, 6%. ECB was over 4.5% rates. Those are some more normal rates that we've seen throughout history. And then you see the crisis and their overreaction, flood the system with liquidity, drive rates to zero, push people into risk assets, and it's worked. People have done that. And we're seeing these lower for longer. But right here at the end, what do you see? There's only so much how low you can go here. There really is only one more direction it can go. We can argue about the timing of it, but these rates have to rise at some time. I mean, think about what they did right here, how it took to do this. Other than just lowering rates, they injected 12 trillion into the market over this time frame, almost 12 trillion. They've just announced that the US at least is going to start pulling this back. So if they had that much impact on the downside with that much money, once they start taking it out, what do you think is going to happen here? I think they'll be much smarter about it, much more prudent. They're not going to be just throwing liquidity at it and taking money out and, fast and furious, but they're going to be consistently taking money out, slowly but surely. That has to have upward pressure on rates. And we look over here on the right, these are the expectations of the marketplace for the future central bank rate. So what's going to happen in the future? You can see it. Everything's turning up. So I just have trouble looking at the fixed income market and finding that it's a safe and easy place to invest when rates are going to be going up one way or the other. I mean, we haven't seen a rising rate environment over extended periods since the 80s. Most of the people in the investing world have never invested in a raising rate environment, including me. I think at least I'm a little bit intelligent to look at history and try to talk to those people who actually invested in it. It's much different than most people have experienced. And we think just blindly throwing money at fixed income markets with the understanding that they never go down is not the right play here. So again, we're seeing the central banks in control. We've seen their impact back in '07, what they can do when they're trying to increase liquidity. And we think that same thing, maybe not to that extreme and not that quick, will happen as they remove liquidity. So again, also you can see the U.S. is kind of leading this charge here, right here with the rates rise. So they're in the lead. So they're further along the cycle. So maybe we again going with that valuation theme that we're seeing in the Europe and Asia, a little bit more valuation support, and the central bank will be supporting asset markets a little bit longer than the U.S. here. So let's go and look at the lack thereof income. So it looks like a busy chart, a lot of things going on here. Let's simplify this and kind of see what we're really talking about here. This dotted line is the global aggregate bond market's historical yield. So what does that mean? Global aggregate bond, I shouldn't say global, it's US aggregate bond index, invest in a whole bunch of different asset classes. They invest in corporate credit, they invest in treasuries, they invest in MBS. And what they do is they're a very diversified fixed income portfolio. So if you think about it, what it's saying is historically, I could just buy this index for very cheap money. It's very diversified, and I could collect a little bit over 4% in income every year. Lock, stock, and barrel. Doesn't matter what's happening to price, they're just going to pay me 4% income. That's what I've dealt with historically. What am I dealing with now in the current environment? So we look at these assets and we're looking really at this purplish blue, depending on how your computer screen looks at it. That's the current yield to worst. So that's not the income, that's not what it's paying, that's what it's paying when it matures. So if you hold this bond, a government index, the same index that used to pay 4%, you're getting 1.1 on the government. The global aggregate is paying 1.6. The Treasury, 1.9. The Barclays US Ag, which is what we're looking at here, 2.5. So almost cut in half the income you can receive. So again, part of measuring the valuation of any asset class is the income it throws off. If you think about an asset class that pays 4% and an asset class that pays you 2.5%, what offers you the better value if you keep risk the same? Obviously the one that offers a little bit over 4. So again, looking at the fixed income world, not a lot of income. Especially these retirees, how are they going to support themselves on a 2.5% bond index? They just can't. And historically, they've been given 4. So how do you get to that 4? Well, you got to take on risk. You got to go into the EM world. Then you just get a little bit above 4.5. Or you go into the corporate high yield index, which has default rates in 2%. So 2% of the bonds out there default every year. And you're still only getting a little bit over what historically you've got on a very safe index. So what does this say? Again, expensive. And what does this tell us as investors? And we look around here, don't reach for yield. It's hot. Think about it as a stove. The burner's on, we can see it, and we just want to reach out to it. And as soon as we touch it, we got to pull our hand away because yield is expensive here. The last thing I'm going to talk about is income before I kind of get into complacency and investor sentiment is the yield curve. So again, the reason I pull this out, we talked about this on the valuation chart of the bond market, is that everything begins and ends with this yield curve. This is how you start pricing fixed income. So it's flatter than it was at the beginning of the year, but it's still steep in terms of the yield curve. So again, looking at the federal government, 1 month, 3 month, 2 year, 5 year, how much the government's going to pay you to lend them money all the way out to 30 years. So again, it still shocks me that you can lend the government money for 30 years and only get 3% from them. It's just so low. But again, what we're looking at here is this yield curve and the indicator of the environment. Once we start seeing this turning and goes negative, if it gets too flat, then it's a good sign of a recession. As we're looking out here, even with this rising rate environment, we don't see this switching to a more inverted yield curve where longer rates are lower than short-term rates. So again, another indicator that we don't see a recession. And again, why are we looking for a recession? Historically speaking, bad bear markets, those 20, 30, 50% drawdowns only happen along with a recession. So again, looking at the multiple lenses, looking for indicators that will make us nervous about the market, This is one more piece of the puzzle that says, even though the valuations are extended, the current environment, given the economic backdrop, is okay to be invested in. So that's the income. So let's go look at complacency. What are we looking at here? We're looking at the VIX. This is what happens when you get 11 straight months of gains. Everybody just gets complacent. So this is the VIX. We do use this in our internal model here as a good contraindicator. So when we say contraindicator, what do we mean? We mean that when it's high, it's good. When it's low, it's bad. In terms of what the expectations for the market. This is just called the fear index. You probably have heard about it. They say the VIX, the fear index. What is this? It's just a measure of what investors think is going to happen to the market, how much it's going to move over the next 30 days. So when it's high, investors are scared. They think the market's going to move a lot, and they're trying to back away from risk assets. When it's cheap or low, right here, like 11, investors are complacent. They're willing to invest money. They don't think the market's going to move a lot, but they think it's going to go up. And it's just a measure of the difference between at-the-money calls and puts 30 days. That's all it's telling us. And you can see this historic just drop. 11 straight months of gains. This is just going down. Investors are complacent. Now again, we've seen that when investors get too complacent, that spells trouble. If you have other conditions being met, and that's going to be a big thing. We need multiple lenses here. But looking at it from this complacency point of view, that it does make us a little bit nervous that investors just don't see risk out there. They think everything's going to be fine. Which hopefully they could be right, but again, historically speaking, eventually they're not. The other piece of complacency is not just looking at the U.S. equity market, which we're all familiar with, but other asset classes. So again, another chart from S&P, which really has some good information for us here. S&P index, emerging market index, EFR, so things we've been familiar with, the high yield index we talked about. Again, these are ranges. How historically has these been volatile asset classes over time? So look at the S&P. The high historical has been almost 30%. The low 7. Where is it? The current is 7, which is right on the lowest right now. So what we're looking at is U.S. equity market low volatility, which we saw earlier. But also when we move out to different asset classes, emerging markets, historical lows. EFA index, historical low volatility. Commodities, low volatility. Bonds, let's go to bonds. Any volatility in bonds? Can't find it. Low and high yield, low in the aggregate, low in the treasuries. So again, these are historically low volatility numbers across multiple asset classes. We're all one asset class now. It's risk on, risk off, and there's no risk to be had anywhere. So let's just keep buying the dip, pushing these assets up. That's the current environment we're in. We do not think this is sustainable. It can be sustained for a while. We do think volatility returns to the marketplace. How that translates, we think it should be in the US first, again, given that high evaluation level. So again, if you expect volatility and you need to be invested in risk assets, you want to invest in assets that have the better valuation support than the higher valuation assets. That'll help dampen that volatility. So again, which is why we move out to EM and international. Again, what we're looking at here is just across the board, investors think everything's good. Again, we started this presentation about Q3 with the Goldilocks. Investors are believing the Goldilocks story right now. Everything is awesome, as my kids would say from the Lego movie they just watched last night. So that's kind of the three things there we talked about. So let's go look at our internal model. So those of you are probably familiar with this model a little bit. You've heard me present on this. I've given to our clients here and there. And this is our own internal capital market risk model. Again, it's a four-legged stool, one being qualitative, with just a judgment of myself, Jamie Upson, and David Giuliano's experience in the marketplaces. The other three are technical, valuation, and macro. So I'm going to spend a little bit of time on the technical here just for a few minutes because we talked about the valuation picture. Again, our model's not telling us anything different that we didn't show you in the other charts we saw. Everything's expensive. You can see red here, so our valuation, negative. We saw that earlier in this presentation. Economy, which has been consistently positive since I've been here, has seen positive, 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 positive. So again, we saw that in the charts. Technical. We didn't really look at technical all that closely. We looked at the VIX index, again, complacency, so that is part of my model, and that's negative. We didn't look at anything else. So when we look at the structure of the market, we want the right asset classes to be outperforming. So again, we want cyclicals, which are more aggressive parts of the market, outperforming staples. We want small caps outperforming large caps. We want the majority of the stocks to be above the 200-day moving average. In simple terms, what does that mean? The more stocks above the 200-day, which means more stocks are rising than falling, which gives you broad support for the marketplace. Markets are strongest when broad, weakest when narrow. So you want to see a lot of stocks going up, making new highs and above the 200-day moving average. And you can see from our model, we are seeing that. The MACD is just another, again, technical indicator. If anybody wants to talk about it in more detail, you can always set up a call to moving average, convergence, divergence. And again, just short-term moving averages against longer-term moving averages, trying to look for tipping points in the marketplace. And the same thing with the RSI. So what we're looking at here as of the end of 9/30/2017 is a model, again, 4 legs. We look at the technical piece. Very positive. A few spots are giving us a little bit of concern here and there. You know, investors are complacent, but not enough to tip it to negative. So positive on the technical picture. Valuation, can't argue at all. It is overvalued. There's nothing I can do about it. The market's overvalued, has been for a while, and we don't see that changing. Economic, again, very positive backdrop. So we're looking at a very positive economic environment, strong technicals, weak valuations, good qualitative picture. Again, we see the Fed and the central banks of Europe and Japan still supporting this marketplace. So again, a qualitative picture of +2 gives us to a positive score of +4. Green is good. Green is also, starts to sound like the movie Wall Street there, green is good, but green is good. Green is the normal state of the markets. Historically, risk markets go up almost 80% of the time. So that's our normal state, is that when everything is good, we're going to take normal risk in client portfolios. That's that green level. The yellow is reducing risk, and red is slam on the brakes. Oh no, a recession's coming. But what we're seeing right now is a very green environment. Things are all right. It's a tough valuation picture with strong economic and strong technicals. If we go back over here, we can see what it looked like last quarter. 6/30, end of last quarter, it was a +5. Now it's a +4. So very little change. So some of those individual indicators changed, but again, a lot of that's just noise going back and forth throughout the market as markets go up and down. What we're trying to really find is that signal through the noise, find out what it's actually telling us. Is it telling us something? And what this is telling us is that there's no change from the past quarter, and markets still look good in terms of being investing. So when we go back a little bit longer, and this goes back to 2012 over here, and this green line is our model. You can see that was very negative when we came on board, when I came on board, Stonehearth Capital Management. Kind of rose up, came down a little bit back in that was a 2015, 2016 scare. But since then, it's been pretty much stable above 0. So again, when we start looking at directions and trends, you can see this has a nice upward slope here, nice upward trend. And this red is the S&P. So again, as our model's saying everything's all right, the S&P is confirming that that's going up. So again, what are we looking for here in terms of tipping points? We're looking for things like this when it goes down like it did in 2015, or when it came back down here over in 08. So we're looking if this goes negative. And again, look at the trend, look at what we're seeing in the data. We're just not seeing it head that down way. So we're positive on assets. So we've kind of went over the entire environment, what's happened in Q3, where we stand on the environment, a lot of the data we look at. What does that mean for client portfolios? How are we positioned? So how do we kind of process this data? So we have the data, then we translate that data into information, so that gives us things to think about, and now we need to transform that into knowledge. How are we going to translate that into how we position the portfolio? So this is our current allocation for clients and diversified as of 9/30. These are recommendations of client positioning based upon relative to Stonehearth Capital's internal moderate benchmark. And if you want more details on that, please feel free to call the office. And the first thing we see is equities are neutral, right in that yellow spot. And again, we talked about it. We're nervous about the valuation picture. These are overvalued assets. We don't want to be way overweight equities. We don't want to be reaching for risk here given the valuation. But we're not seeing anything in the marketplace in the technicals or the economics to say we should be way underweight. So we're neutral. But again, when we start breaking down how we have our equity exposure, we talked about where are those pockets of assets that have good valuation support or better valuation support than others. We look at international developed and emerging markets. So we're underweight US, overweight international and emerging. That's been paying off recently in the past few quarters here as international EM has been taking over the US. They haven't closed that valuation gap enough yet. We still think there's some time and room in this trade, but we want to maintain our overweight international and emerging markets compared to US because of that valuation picture. We're finding more valuation support. So if that volatility starts creeping back into the marketplace, that we're going to have that valuation support to make us less volatile than other asset classes like the US. Fixed income, underweight. Again, we saw the lack of income. You're not getting paid to take on this extra credit risk. We'll look at where the rates are from the central banks. There's not really a lot of room on the downside. They could stay flat for a while, which is fine for fixed income, but doesn't really give you any juice, any positive major return, just kind of gives you a flat return. We don't think that's good compensation for taking on that risk of that central banks lose control of inflation and they start raising those rates a little bit high, or just a policy error. I mean, Donald Trump is deciding on the new Fed chair this week. So again, could there be an error there? Maybe. Could cause some dislocations in the fixed income market. We don't want to be overweight fixed income in the face of rising rates. Cash neutral. Again, we use cash as an opportunistic asset class. We view cash as that when we don't see a lot of opportunities out there, there's not a lot of valuation support, markets are getting scared, we can hold cash. We don't earn a lot on it, but we think of the opportunity cash gives us. What the opportunity does it gives us? It gives us the opportunity to buy stuff cheaper. So if we think things are going to go down, things are getting expensive, we see some nervousness out there, we can increase our cash balance. Why? To take advantage of some of that volatility that we may see. Again, we're currently underweight the US. All else being equal, we see the US increase in volatility, some assets drop to more realistic valuation levels, we can deploy some of that cash into the US markets. Again, that's just an example, not something we see happening, just an example of what we could do with cash and how we use cash in clients' portfolios. Commodities, again, we're underweight. I think we're going to be underweight for a while. We don't want to be exposed to commodities here given the current environment, but again, it's a small piece of the portfolio anyways. Position we really like is alternatives. It's overweight in our client portfolios. Again, we use managed futures, we use a merger arb product. Again, looking for anything that is not dependent on the US, international, or emerging market equities, or the fixed income market going up to generate return. So again, managed futures, merger arbs, they don't need a rising risk environment to generate positive returns. And we think that given what we're seeing in terms of the muted returns out there, not a lot of valuation support, that alternative is a good place to generate some decent returns for client portfolios right now. So that's kind of our diversified portfolios. And again, this goes across our portfolio lineup. We have 3 different diversified models, conservative, moderate, and aggressive, and each one has a carbon light version of that. So carbon light conservative, carbon light moderate, carbon light aggressive, where we actually measure the carbon footprint of your portfolio and reduce it in the carbon light versions. So that's the diversified world. Let's take a look at, we also run one more model here. We run a US stock portfolio internally. We've run it since the beginning of 2016. All these stats are as of 2017. The first thing this kind of gets across is we look at this technology. We're way underweight technology, almost 10%. Again, you don't need FANG, which is Facebook, Amazon, Netflix, Google, which is called now Alphabet, to outperform. There are, again, just like we saw in diversified portfolio, there are pockets of valuation support where you can find things you don't think about. And the way to look at that is think about it this way. FANG stock, so Amazon, what has Amazon done over the past year and year to date? So to buy Amazon, you have to pay 277 times earnings, so price earnings ratio, 277. Where if we look at Boeing, right here, our second biggest holding, trades at 10 times. We look at Thor Industries, again, those things that people don't see, the maker of campers, the RV campers, they're trading at 19 times. So again, a lot cheaper than Amazon. And how have they performed? So we look at the past year-to-date number, Amazon's up 46%, great investment. Wish I was up 46% in Amazon. But I can go buy Boeing with a lot cheaper valuation, better valuation support, it's up 64% on a year-to-date basis. Thor Industries, trailing Amazon a little bit at 35, but then I go look at the past year, Amazon's up 34%, again, great return, better than the S&P. But look at Boeing with that valuation support, it's up over 78%. Thor Industries, 71% up over the past year. So again, the press sometimes focuses on these main stocks and everybody starts talking about them, and they are overvalued, and we do not think they offer good valuation support right here, but there are pockets of the market that you can find it. So again, which is why we're overweight Boeing, overweight Thor. How do we find these stocks? Well, we have an internal model that we run our portfolios with, and basically it's a four-pronged model. We look for stocks trading at valuation levels that support good price growth, again, cheap stocks. We look for quality stocks, good management. They take care of shareholders. They invest capital wisely. We look for yield. Are they returning cash to shareholders, giving you dividends back, buying back shares and helping you out as a shareholder? And then we look at momentum. Are they having positive momentum? And the reason being is that we want to own stocks that are kind of turning up, not turning down. And that leads us to find these undervalued bargains in the marketplace that offer these returns. So again, it's not all about FANGs. There's a lot of stocks out there trading at cheap valuations with tremendous free cash flow, and then we can find them using our model here. So again, it leads us to industrials. We saw that the Boeing, Thor, Southwest Airlines love the industrials. The other thing we look for that doesn't look like we like is financial services here. We're underweight. But that kind of hides the fact that we're overweight banks. Again, harking back to our fixed income piece of this presentation, rates are going to rise. Rates rise helps banks. They just do. They lend long, borrow short. So as long as rates rising, they get some good net margin compression. It spreads out, they earn more money, so we think that's good for them. So we like the JP Morgans of the world. Fifth Third is another one we own that's very good in terms of providing some upside potential here. So again, it's not all about tech, it's not all about FANGs. No matter what the press keeps telling you, there are other pockets of the market that we're seeing healthy growth in free cash flow and valuation support to provide support and hopefully provide some excess returns over the S&P going forward. So again, if you would like to learn more about the U.S. stock portfolio, please give the office a call, 978-624-3000. I'd be happy to talk more about it. Before I move on, I do want to mention one thing. If you look over here at our weights, energy, we hold 0% in our stock portfolio. Basic materials, 0% in our stock portfolio. That's not by mandate. So there is not a mandate to say that this has to be energy free or basic materials free. A lot has to do with the risk of stranded assets that these energy and basic material companies hold. And if you want to learn more about stranded assets, please check out previous webinars on carbon light investing. That kind of goes through our viewpoint on stranded assets, what the impact they could be to equities, and how we think investors should be handling those in their diversified and stock portfolios. So again, please check that out if you want to learn more about stranded assets. So let me just sum up kind of what we went through here. Again, we went through a lot of information, a lot of data, and these are kind of my final words on what we're thinking about here. So again, extended valuations, very much a concern, but the global growth story does remain intact, at least for now. We'll have to see how the data comes out, but everything we're looking at in the marketplace right now is saying that the global growth story is there and it's intact. Technical picture remains healthy. Small caps outperforming large cap on a longer term basis. We're seeing the right parts of the market outperform. We are seeing investors get a little bit complacent, but we're not seeing it overextended in terms of the RSI and the MACDs, and we're seeing a lot of stocks, a lot more stocks going up than going down in the marketplace. So again, given that backdrop, you want to pay attention to where your risk exposure is coming from within the equity markets. It's not just to say I want to reduce risk, you got to make sure you're taking the right risk. Again, we like international, including EM over US. And we definitely like the value trade over the growth trade. Central banks, they continue to intervene in the markets, and that's going to lead to reduced opportunities for yield. Again, careful reaching for yield or chasing risk in these marketplaces. You're going to get burned. Expect muted long-term returns for traditional asset classes, equities and bonds. Again, we talked about alternatives. We want to remain overweight these alternative asset classes. And again, how do you define, at least how does Stonehearth Capital define an alternative asset class? It's any asset class that's return stream, does not rely on a rising equity or bond market. Again, the markets don't have to go up to generate positive returns in this asset class. And we think, given those muted long-term expectations of returns going forward, that earning those high, maybe mid-single digit returns are going to look very attractive on a 10, 15-year basis, given the valuation pictures we've seen. So before I turn it over to Amanda for questions, in Appendix A, you can run through it real quick. That's how we calculate the performance on the first chart we showed you. And these are compliance disclosures that you should read based on what the lawyers tell me you have to read. So with that, I'm going to turn it over to Amanda and see if there's any questions in the queue.
Hi, Chris. Thank you so much. That was so much great information for us. We do have a few questions, but just as a reminder, the questions box is in the bottom right corner of your taskbar, so please go ahead and just type in your questions there, and we'll get to as many as we can. The first one I have is there are a lot of questions in the queue specifically about the political environment, especially as it relates to our current commander-in-chief. Can you explain how the political environment enters into your investment process, and has it changed since President Trump was elected?
Sure. So I thank you for being very political on that question, Amanda. That's probably the number one question we get from clients, and it's funny, how does the recent election affect? How does the recent tweet? I mean, I think that's, to me, the one biggest thing that's changed in my world since President Trump's been elected is that I actually have to look at my Twitter account in the morning to see what's going to kind of go on in the marketplace, to see what he's done. Traditionally, politics has had little impact on the markets. It's funny, and you kind of hark back to President Barack Obama. So you remember when he was first elected, came into office, every single capitalist I know said he's bad for the markets, he's a liberal Democrat, it's not going to work, and we've seen markets go up over 80% since when he was in office. Again, very little impact. If you could predict what legislation would come out of Congress, then yes, I think it should be in your investment process. I've never been able to do that, and I've never seen anybody on a consistent basis been able to do that. So again, like everybody else, we follow it closely. I think the big takeaway for me is not so much predicting how it's going to impact in the future, is that knowing once something happens, once it gets translated out there into the environmental sphere, policy gets passed, legislation gets passed, someone gets elected to a Fed Board of Governors, or someone gets nominated for Treasury Secretary, we know how to process that information and translate that into the portfolio. So again, that transmission mechanism is really after the fact it happens. What are the impacts going forward for the next 3, 5, 10 years, not that immediate, 10-second either up or down movement based on some tweet that our commander-in-chief does. So again, we look at it, we help it to form the current environment that's out there, but we don't use it as a direct input into our investment process. We don't think it adds any value in terms of being able to build better portfolios for our clients.
Chris, given your expectations of a rate rise, why invest in bonds at all?
Good question. I was very negative on bonds, and I was that on purpose because I think when I look out at investors and I talk to them and I go out and I give client presentations, talking to clients, they're used to bonds just kind of being there, never losing money. There is a way to lose money in bonds. Yes, if you buy an individual bond cheaper than par, which is a big thing these days, a lot of these bonds that you get that say, oh, you have 6% income, they're also trading at $110. Well, you only get $100 back at maturity, so you have to reduce that income by a lot because it's going to accrete down to the $100. So I'm really trying to make investors aware that fixed income can be risky. The one thing to look at in terms of risk is, again, without risk, you can't generate any return. So there has to be some return with the fixed income. It's just where you want to take it. We take it in asset classes that are offering some protection to those rates rise. We're taking on credit risk. We're looking at floating rate, looking at more short term, looking at a strategic income fund that can manage the duration risk. So again, we don't want to be naked because it does have properties that we like. It's kind of acts as ballast, less volatile, and there are pockets that we're finding where we can add value in a diversified multi-asset class portfolio. We still think it belongs in the client's portfolio. We just want to be underweight compared to where we have been historically.
What happens when the Fed starts tightening?
Good question. We're going to see a lot of volatility, I think. I think it's not so much what happens when they start if they start tightening, it's kind of what happens when and how they tighten. So the big thing to me is they've been very good at projecting what they're going to do over the next 3 or 4 meetings, and they've been very clear that they're watching the data. They're looking for inflation. They're looking at the job picture. So if you look at the job picture, employment's at some of the historic lows it's ever been, but we're not seeing inflation, which kind of goes against everything I learned in economics, that if jobs are hard to get and wages are rising, then that should translate into inflation. That hasn't worked. Is that mechanism broken? Don't know. That's what the Fed's watching. So far, so good, raising rates in a slowly measured manner. But again, Our president has to pick a new Fed chief this week. I think he said the announcement's going to be on Thursday, and see how that turns out. So depending how fast they rise, you could see some big dislocations in the bond market as people adjust to the new normal. Again, we talked about earlier in the presentation, rates haven't risen over extended periods since the 80s. People don't know how to react. They're going to be walking into the fear of the unknown. So I think you're going to see some dislocation in the fixed income markets. And again, which is why that we have a diversified multi-asset class portfolio, and then we can take advantage of some of those dislocations. But I would expect increased volatility across all asset classes. So that complacency chart we looked at, that thing will spike, I think, once Feds start raising rates for real.
The next question I have is, what is the most important indicator you are currently watching?
Another good question I get a lot. I don't have any important indicator. We look at the world through a multiple lens. And again, if you kind of look back and think about that chart we showed you of our risk model, where we had all those indicators, you saw some intra-month volatility. So if we looked at any one indicator, that could push us over and change our viewpoint. But again, it wouldn't help our clients. It doesn't help us outperform. You really need to look at a multiple lens. So again, you need to look at the entire picture. There's no one indicator more important than another. If you want to look at the total picture, make sure what it's telling you, and again, using that information from data to information to knowledge. And part of translating it into knowledge is looking at the total picture. So there's no one indicator we're looking at in terms of that's going to drive us either to increase risk or decrease risk. It really is looking at the total picture. And if one indicator goes up, we have to see how that impacts and flows through to every other indicator we follow to really before we make a decision in terms of the risk or the asset classes we're investing in. So really is no one indicator out there. You need to look at the total picture.
The next question I have is, why no Amazon in the portfolio or in your portfolio?
Amazon, yeah, I did try to address that a little bit. I knew it was going to come up. Again, you get the question all the time in this industry. Why don't I just invest in Amazon? Well, I look at Amazon, and the difference to me is, and I kind of grew up during the Peter Lynch era, right? I admired him. He's a PM, for those who don't know, in Fidelity. They used to run the Magellan Fund, and he generated market-beating returns for over 15 years. He was just an amazing investor. And again, he always talked about great company, great stock, and there's a difference. Amazon is a great company. It's changing the world. It's disruption industries every other week. Doesn't mean it's always a great investment. We look at this past earnings quarter where it grew revenue over 30%, but the money it makes, how much money it actually takes in, that actually decreased. The profit margins are under 1%. So even though they're increasing all this revenue, they're not making any more money. How do you value a stock? On how much money it makes? Because you get part of those earnings back to you. So you're not really getting anything in terms of earnings. So what do you have to believe to invest in the stock? You have to believe that at some point Amazon's going to be able to raise their prices. But if their whole business model is by lowering prices to take market share, you have to think, when is that going to change so they can actually raise prices? I have a hard time seeing that. So again, it really is the difference between a great company, which Amazon definitely is. It's changing the world. It's a leader and will be a leader for the next 10, 15, 20, 30 years, and a great investment, which I just don't see it because of that valuation and how much money it doesn't make in this marketplace.
What are the greatest risks to the markets right now?
Good question. Central banks, again, do they lose control? Do they make a policy error? Do they raise rates too much? They're not raising them enough. Again, to me, that's really what really keeps me up at night in terms of what I can view and can control. The other risks out there, again, North Korea is still out there. We haven't heard about them in a while. So again, there's always geopolitical risks. You really can't defend against that because, again, looking back to the political environment, how you predict what North Korea is going to do with their nuclear weapons, if they even have any nuclear weapons right now. They have some, but can they launch it over to the U.S.? So again, geopolitical risk. The Fed is the real main one, and again, in relation to the Fed, inflation. We've been in a very low inflationary environment. We have seen throughout history, though, that once inflation starts rising and runs, it's very hard to contain it. So again, inflation, Fed, and geopolitical risk is kind of what I look at in terms of biggest risks to this market right now.
You just touched base a little bit about this, but what keeps you up at night?
Yeah, again, that's that inflation and central banks. Again, do they make a policy error? Again, I always worry about geopolitical risk, but they've always been there, always will be. There's really nothing you can do about that. They're always going to be there. The Fed with rates this low, wages increasing and increasing, inflation this low is not always there. So that's the way I think the one error could be, that we could kind of do a self-inflicted wound. If we raise rates too much, don't raise them enough, we let inflation get away from us, we could really start causing very major dislocations in these asset class markets, which again could translate into investors getting nervous because they're so complacent, which could portend to massive dislocations in different markets. So that's kind of where it keeps me up at night. It's kind of how that translates into all the asset classes based on what the Fed's going to do.
Thanks so much, Chris. It seems we have quite a few more questions and we're running out of time here. So in respecting everyone's time, if we didn't get to your question, Chris will reach out to you directly. Also, if you do come up with a question regarding the webinar from today, please feel free to call our office at 978-624-3000. Chris would be happy to speak to you with any questions that you have. And thank you all for joining us today. Thanks, Chris.
Yep. Thank you, Amanda. Thank you, everybody.